When a company's stock takes a nosedive after its first earnings report since going public, it's bound to raise eyebrows. But here's the twist. Figma, the popular design software company, isn't just any ordinary tech startup. Despite posting solid numbers, its shares plummeted by 14% in after-hours trading on Wednesday, following the release of its financial results for the first time since its initial public offering IPO back in July 2025. So, how did Figma perform compared to Wall Street's expectations? Let's break it down. The company reported earnings per share that essentially broke even, neither profit nor loss, and generated $249.6 million in revenue. This slightly exceeded analysts' projections of $248.8 million. Revenue grew an impressive 41% year-over-year, climbing from $177.2 million in the same quarter last year. Back in July, Figma had given investors a sneak peek into its expected performance with a preliminary revenue estimate ranging between $247 million and $250 million, which turned out to be right on target. Now let's talk profits, or lack thereof. For the second quarter, Figma reported a modest net income of $846,000. A stark turnaround from the staggering $827.9 million loss they incurred during the same period in 2024. Adjusted operating income landed at $11.5 million, comfortably within their earlier guidance of $9 million to $12 million. These figures are particularly noteworthy because this marks Figma's inaugural earnings report as a publicly traded company. Looking ahead, Figma is optimistic about its future. The company predicts revenue for the third quarter to fall somewhere between $263 million and $265 million. If these forecasts hold true, it would translate to roughly 33% growth when measured against the midpoint of that range. Analyst consensus via LSEG pegs the expected figure at $256.8 million. Additionally, Figma anticipates full-year adjusted operating income to range from $88 million to $98 million, alongside total annual revenue surpassing $1.02 billion, ahead of the $1.01 billion analyst consensus. This implies a robust 37% year-over-year growth rate. But here's where things get intriguing. Last year, Figma introduced Dev Mode, a feature aimed at helping software developers implement designs created using Figma's platform. While this innovation boosted revenue initially, CEO Dylan Field admitted in an interview that it has somewhat dampened growth projections for the current quarter. However, he remains confident about the long-term benefits. Figma hasn't been resting on its laurels either. Earlier this year, in May, the company unveiled two groundbreaking products: Figma Make, which uses artificial intelligence to generate app and website designs based on user descriptions, and Figma Sites, a tool that transforms static designs into fully functional websites. They also acquired Modify, a vector graphics startup, and Payload, a content management system startup. Though Figma hasn't yet begun charging fully for its AI-driven offerings, it has already factored the associated costs into its financial model. Praveer Melwani hinted during an analyst call that customers may soon have the option to purchase additional AI credits. This brings us to a hot topic in today's tech landscape. Will AI displace traditional roles like designers? Several software companies have faced scrutiny over this very concern. However, Field reassured CNBC that he hasn't observed such trends internally. In fact, he believes designers will only grow more indispensable as AI simplifies software development. The easier it becomes to build software with AI, the more people will realize the importance of the human touch, Field remarked. He added that Figure itself is experimenting with vibe coding tools, AI-powered systems that assist in coding, which echoes sentiments expressed by other tech leaders, like Microsoft's Satya Nadella. Another key metric worth noting is Figma's net retention rate, which stands at 129%. This means existing customers are spending more money with the company over time. Although this figure dipped slightly from 132% in the previous quarter, it still reflects strong customer loyalty and engagement. And there's more drama brewing behind the scenes. Following its IPO, Figma disclosed that a lockup period restricting employee stock sales will expire for 25% of certain employees' shares on September 4th. Interestingly, investors holding just over half of Figma's Class A stock have agreed to extend their lockups, with the final 35% expiring in August 2026. Field emphasized the importance of transparency for shareholders, stating, "I think providing clarity is incredibly valuable information." Before diving deeper into the numbers, let's rewind to Figma's IPO day. Shares were priced at $33, but soared to $115.50 on their debut, a remarkable pop. Fast forward to Wednesday, and the stock closed at $68.13. Meanwhile, Figma continues to expand its enterprise footprint, boasting 1,119 customers who contribute more than $100,000 annually in revenue, up from 1,031 in the March quarter. On the balance sheet front, Figma appears financially sound. As of June 30th, the company held approximately $1.6 billion in cash, cash equivalents, and marketable securities. Notably, $90.8 million of that sum is invested in a Bitcoin exchange-traded fund, ETF. When asked about this unconventional move, Field joked, "We're not trying to be Michael Saylor here," referencing the outspoken proponent of Bitcoin and CEO of MicroStrategy. He clarified, "This isn't a Bitcoin holding company, it's a design company. But I do believe there's room for Bitcoin as part of the diversified treasury strategy." As you can see, Figma's journey is far from straightforward. Its recent stock decline might seem alarming at first glance, but the underlying story is much richer and arguably more promising. Still, questions linger. Do you think Figma's focus on AI will ultimately strengthen or weaken its competitive edge? And what about its Bitcoin investment? Is it a savvy hedge or an unnecessary gamble? Share your thoughts in the comments below.